Imagine discovering something buried beneath the surface of the earth. Something so useful, so energy-dense, that over time, entire economies begin to organize themselves around it. Not all at once, not by design, but gradually, until it becomes almost impossible to separate modern life from the systems it enables: the movement of goods, the cost of travel, the price of everyday products, even the materials that surround you right now, and whether you realize it or not. You interact with this system every single day. At the gas station, through the price of everything you buy, even in things that seem to have nothing to do with energy at all. Now, imagine realizing that the real value of that discovery isn't simply in producing it, it's in controlling everything that happens after it leaves the ground. Because once you control how something moves, how it's processed, and how it reaches the market, you don't just participate in the system, you begin to shape it. This isn't just an industry, it's infrastructure that everything else depends on. To understand how that happened, you have to go back to a time when oil was not yet organized into a system at all, the late 19th century. Production is fragmented, prices are unstable, supply surges unpredictably, and collapses just as quickly. What exists is not a structured market, it is volatility, playing out in real time. And into that environment steps John D. Rockefeller. What he understands, earlier than most, is that competing within that volatility is not the path to control, because the real leverage point is not production, it is coordination. Instead of focusing on drilling, he begins acquiring the parts of the system that determine how oil becomes valuable: refining capacity, transportation networks, distribution channels. Over time, this creates influence, not over how much oil is found, but over what happens to it after it is found. At its peak, his company accounts for roughly 90% of oil refining in the United States. Not production, refining. That distinction matters, because refining is what connects raw resource to usable product. Eventually, the system becomes too concentrated, and in 1911, it is broken apart. The assumption is that this will dismantle its power, but what it actually does is distribute it, because the system that had been built doesn't disappear, it fragments, and then, over time, begins to reassemble in different forms. Through competition, through consolidation, through scale. What was once centralized becomes networked, and that network becomes the foundation of the system we still operate within today. But here's where most people misunderstand this industry. Because if it were just one business, it wouldn't survive. What actually exists is a layered system, one that generates value at multiple points, under different conditions, often at the same time. And understanding that system is the key to understanding everything else. The upstream segment, exploration and production, is where uncertainty is highest. Finding oil, drilling wells, bringing hydrocarbons to the surface. It requires enormous capital, long timelines, and technical complexity. A single offshore project can require investments exceeding $10 billion before a single barrel is produced, and even then, success is never guaranteed. This part of the system is highly sensitive to global oil prices. When prices rise, returns expand quickly. When they fall, this is where the pressure shows up first. The midstream segment, transportation and storage, is structurally different. Pipelines, shipping routes, storage systems, thousands of miles of infrastructure, operating largely unseen, connecting production to refineries, markets, and ports. Revenue here is tied less to price and more to flow. As long as oil is moving, this part of the system continues to generate value. The downstream segment, refining and distribution, is where crude oil becomes usable. Fuel for transportation, feedstocks for chemicals, materials used in plastics, textiles, and manufacturing, the plastic in your phone, the fibers in your clothes, the asphalt beneath your tires, and this is where the system becomes counterintuitive. Because when oil prices fall, refining margins can improve. Lower input costs, wider margins, which means that what looks like a downturn in one part of the system can become an advantage in another. This isn't volatility. It's a system that has learned how to turn volatility into an advantage. And that's why it doesn't behave like a single business. It behaves like an interconnected structure, one that moves pressure around instead of breaking under it. And if this system is so resilient, why does it sometimes feel so fragile from the outside? In 2020, that question was tested in a way the industry had never experienced before. Global demand didn't decline gradually, it collapsed. Air travel slowed dramatically. Road traffic diminished. Industrial activity contracted. At the same time, supply didn't adjust fast enough. In some cases, it even increased. And then, something happened that had never happened before. Oil prices, specifically certain futures contracts, briefly turned negative. Not simply low. Negative. For a short period of time, it became cheaper to give oil away than to store it because the system had reached a physical constraint. Storage filled, pipelines backed up, tankers waited, with nowhere to unload. This wasn't just a pricing issue, it was a structural one. The industry experienced massive losses, halted projects, and operational disruption. And for a moment, the system looked like it might not hold, but it did. Demand returned, supply adjusted, prices rebounded, and within a relatively short period of time, profitability returned as well. What looks like instability from the outside is often where the system makes its money. And this is where public perception begins to break down, because what feels like excess is often just how the system is designed to function. And this is where the system becomes easier to feel, but harder to understand. Because most people experience it the same way. Something happens somewhere in the world. Supply feels uncertain, prices begin to rise, fuel becomes more expensive, shipping becomes more expensive, food, travel, everyday goods. Everything begins to move with it. And it raises a simple question. Why does something happening far away change what you pay for everyday life? From the outside, it looks like a single reaction, one event, one outcome, but inside the system, the response isn't singular, it's fragmented. Different parts of the system react at different speeds, under different constraints, with different incentives. Production cannot increase instantly. Infrastructure cannot reroute overnight. Refining cannot adjust without limits. And demand, at least in the short term, doesn't disappear. So what you get is not a smooth adjustment. You get friction. And friction, in a system like this, does something important. It creates gaps. Gaps between supply and demand. Gaps between regions. Gaps between when something is needed and when it can actually arrive. And those gaps are where pricing moves. Not evenly, but sharply, sometimes unpredictably. And that's where the system redistributes value, because while higher prices create pressure for consumers, they create opportunity for certain parts of the system. Not uniformly, not always, but consistently enough to matter. This isn't a system that avoids disruption. It's a system that continues through it, and in doing so, redistributes its effects. But even this system operates within something larger, because a significant portion of the world's oil resources is controlled by national oil companies, entities owned by governments. These organizations operate alongside private firms, but under different priorities. Revenue matters, but so do national budgets, geopolitical strategy, and long-term resource management, which means oil is not just an economic asset, it is also a strategic one. And when decisions are made about how much supply enters the market, the effects extend far beyond the industry itself. Prices shift, markets adjust, and those changes ripple outward through economies, through industries, and ultimately into everyday life. So, how did one industry learn to generate extraordinary returns over time? Not by controlling a resource alone, but by operating within a system that captures value across multiple stages, adapts to changing conditions, and continues to function even under pressure. It doesn't eliminate volatility. It moves it, and that's why it has lasted. Not because it's unbreakable, but because it has been structured, over time, to survive almost everything. Except, systems like this don't fail when demand disappears. They face pressure when the numbers stop making sense. Gradually, quietly, in ways that are easy to miss until they're not. And by the time that shift becomes obvious, it's already underway. Not driven by headlines, not driven by policy, but by something far less visible: the math. And once you see that, you don't just understand how this system works, you start to see where it leads next.